The market looks at PayPal and sees a broken business, a relic from the early days of the internet, getting slowly picked apart by big tech. But when you actually dig into the data, it's not just telling a different story, it's telling the exact opposite story.
All right, just look at this number. 10 times forward earnings. That's a valuation you usually see on companies that are in terminal decline. Think dying industrial manufacturers or businesses facing some kind of existential crisis. Not a dominant fintech franchise with a global footprint. The market is basically pricing this thing like it's already on life support. And the disconnect gets even crazier when you put it side by side with everyone else. PayPal isn't just cheap compared to its high-flying peer Adyen, which trades at nearly 30 times EBITDA. It's cheap compared to Block. Heck, it's even cheap compared to the S&P 500 average, the entire collection of major US companies. And that free cash flow yield, we're talking around 10%. That's more than double the average company. So this is the big question, right? How does a company with a balance sheet like a fortress, one of the most recognized brands on the planet, and over 400 million active accounts, how does it get valued as if it's about to go out of business? It's the puzzle on Wall Street that nobody seems to be able to solve. What you're seeing here is a classic arbitrage of perception. It's when the story everyone believes is completely detached from the reality of the cash flow. And look, that's exactly what this channel is all about, tracking these kinds of disconnects before they become obvious to everyone else. Okay, so to really get the opportunity here, you have to respect the fear. The market isn't just being irrational, it's genuinely scared of something. So let's do what most people don't. Let's tackle the bear case head on. We're going to deconstruct it piece by piece. And this is the big one, the ultimate fear. The idea that PayPal is basically the BlackBerry of payments, that it's being steamrolled by these super smooth OS-level wallets like Apple Pay. The narrative goes that as everything moves to mobile, that simple fingerprint scan is just going to kill the old PayPal log. But again, look at the data. It tells a completely different story. PayPal's core branded checkout, the actual button, the thing that's supposed to be dying, grew its volume by 8% last quarter currency neutral. This is not a melting ice cube. This is a mature business that's still growing faster than the overall economy, and it's protected by this deep moat of consumer trust that it turns out you can't just replace with convenience. All right, so if it's not dying, what's the other big bear argument? Well, it's the margins. The story goes that because PayPal is processing more and more of these low-margin payments for its Braintree business, the engine behind Uber and Airbnb, its overall profitability is getting crushed. But this is the absolute key that almost everyone misses. Yeah, the blended margin rate, the percentage, has been under pressure, but the actual number of transaction margin dollars, the real profit the company is banking, is not only growing, it's actually accelerating. We're talking 6 to 7% growth. A dying business does not see its profit dollars expand. And you know what? This is where most analysis just stops. They see slowing revenue, they see margin pressure, and they're out. But that's just scratching the surface. The real story is just getting started. So this brings us to the real bull case. Let's peel back the cover and look at this hidden engine that the new management team is building, a machine that runs on capital efficiency, aggressive share buybacks, and just raw, unfiltered cash flow. Okay, the huge shift that the market has completely failed to price in is this. PayPal is changing its DNA. It's moving away from being this sort of bank, holding credit risk on its own books, which, deserves maybe an 8x multiple, and it's becoming a capital-light tech platform that just originates assets and sells them off for a fee. That's a completely different business, one that could easily command a 20x multiple. A perfect example of this is the recent deal they did with Blue Owl Capital. Think about it like this. PayPal creates a buy now, pay later loan, but instead of sitting on that loan and all the risk, they instantly sell it to Blue Owl. Boom! That frees up billions of dollars in capital that was just stuck on their balance sheet. And what do they do with all that fresh cash? They pour it right back into their massive share buyback flywheel. And the scale we're talking about here is just staggering. This isn't some token buyback. We're talking about a share repurchase program of around $6 billion every year. That is one of the most aggressive capital return programs you'll find anywhere in the market today. So what does that actually mean? Well, at today's prices, a $6 billion buyback literally erases almost 10% of the entire company every single year. This is what we call a cannibal, and it creates this mathematical floor under earnings per share. Even if their net income stayed perfectly flat, your earnings per share would still grow by double digits just because the number of shares is shrinking so fast.
If this is the kind of breakdown you don't usually see, well, that's intentional. We believe understanding how the machine works is a lot more valuable than just watching a stock chart. Subscribing just means you won't miss the next one.
Okay, so the buyback puts a nice floor under the stock, but the real massive upside, that comes from winning the war that's being fought right now for the future of online checkout. And this is a battle of platforms, of walled gardens, and some very clever Trojan horses. To really get what PayPal is doing, you have to realize it's basically two different companies under one roof. First, you've got the branded checkout, the classic yellow button. That's the fortress, the cash cow. It runs on trust, and it has these amazing margins. Then you have Braintree, the unbranded plumbing in the background. That's the scale play. It operates on razor-thin margins to go head-to-head with Stripe and Adyen.
For the longest time, the mantra was growth at any cost, even if it meant onboarding tons of unprofitable Braintree volume. But the new CEO, Alex Chris, he's completely flipped that script. The new game is called price to value. They're actually walking away from what they call empty calorie revenue if it doesn't hit their profit targets.
And this is their secret weapon in the checkout war. It's called Fastlane. It's their one-click guest checkout technology. Now, here's the genius part. It lets PayPal recognize users even if they aren't logged in. It uses their massive database of credentials to pre-fill everything, and it's boosting conversion rates by over 50%. This is a direct shot across the bow at Shopify's ShopPay and Stripe's Link.
But this move has kicked off a full-blown platform war, especially with Shopify. Shopify sees Fastlane as a massive threat to its own checkout dominance. So what did they do? First, they tried to force all PayPal transactions through their own system. And now we're hearing they're actively suppressing, even hiding, the Fastlane button for merchants. It's gotten so bad that another competitor, Sezzle, just filed an antitrust lawsuit, basically claiming Shopify rigs its entire payment system to favor its own stuff.
So this brings up a really interesting possibility. You've got regulators at the DOJ and the FTC going after walled gardens like Apple and Google with everything they've got. So could a regulatory crackdown on Shopify's anti-competitive behavior be the ultimate unexpected catalyst for PayPal? I mean, if Shopify is forced to actually open up its platform to fair competition, it could unlock a gigantic market for Fastlane, literally overnight.
See, understanding these second-order effects, the regulatory chessboard, the power dynamics between platforms, that's how you get ahead of the market. This is why people stay.
But there is one last piece to this puzzle, a piece that right now the market is valuing at exactly zero. And that's this huge, unpriced call option on the future of AI. We are on the verge of a completely new era of commerce. People are calling it agentic commerce. This is a world where AI agents, not humans, are the ones initiating and paying for things. Just imagine asking your AI to book you a trip, and it just does it. It finds the flights, books the hotel, pays for everything, all without you lifting a finger.
So how does that actually work? Well, a human just states their intent. Book me a flight to New York for under $400. The AI agent goes out and does all the complex work. But for that final transaction to happen, the agent needs a payment rail that can verify its identity and handle delegated authority. PayPal is positioning itself to be that fundamental trust layer.
And look, this isn't some far-off theory. They're making real moves right now. They've got partnerships with OpenAI and Google. They've integrated with Anthropic's new protocol. And they just launched something called the PayPal Agent Toolkit to make it incredibly simple for developers to plug PayPal's payment system directly into their AI apps. They are literally building the rails for this new world.
So here's the bottom line on this. PayPal is building the payment infrastructure for a world where machines pay other machines. And at 10 times earnings, the market is essentially telling you that the probability of this future happening and PayPal being a part of it is zero. It's being given absolutely no credit for this massive opportunity.
And that's what creates this incredible asymmetry in the trade. Let's look at the scenarios. In the floor case, let's say there's zero earnings growth. Well, the buyback alone still gives you an 8% annual return. Now in the base case, with just some modest 10% growth on top of the buyback, you're looking at an 18% compounder. And in the bull case, if the market just wakes up and decides to value this thing at a totally reasonable 15 times earnings, still a discount to the average company, by the way, that's a 50% jump from here, plus the underlying growth.
So here's the takeaway. The market is punishing what it thinks is slowing growth. It's punishing a strategic pivot that it just doesn't understand. But when you look at the data, what you actually see is a structural turnaround in profits, an incredibly efficient capital return engine, and a deeply, deeply undervalued call option on the future of commerce.
Look, most people just watch the markets. This channel explains why they move. If you want to stay ahead of that curve, subscribe.